Is TLS undervalued? While many ASX stocks look expensive in April 2026, one Australian giant is flashing a rare buy signal. Telstra is currently trading around $5.43, but the underlying numbers tell a much bigger story. Today, we are looking at why an 8% profit jump and a massive share buyback make this one of the most undervalued opportunities on the market right now. Let's look at the proof. In finance, we use the P/E ratio to see if a stock is cheap. Telstra's P/E is 27.3x, which is significantly lower than the broader telecommunications sector average of 54.9x. But the real winner is cash EBIT. Telstra's earnings grew by 14% this half. When a company's actual cash profit grows by double digits but the stock price stays flat, that is a classic undervalued gap. Major analysts like Macquarie currently have price targets near $6, suggesting a nearly 10% upside from today's price. For Australian investors, the big draw is the dividend. Telstra just boosted its interim payout to 10.5 cents per share. Because this is 90.5% franked, the tax benefits make the yield much higher than it looks on paper. Plus, management is so confident that they've increased their share buyback to $1.25 billion. They are literally using their cash to retire shares because they know the market is underestimating the company's value. Now let's talk about the real money. For many investors, the big draw to Telstra is the passive income. But if you are only looking at the cash payment, you are missing the most important part. For the April 2026 interim dividend, Telstra isn't just giving you 10.5 cents per share in cash. They are also including a special, tax-paid gift. Because this dividend is 90.5% franked, it means the company has already paid the tax for you. When we gross up the dividend by adding that 4.1 cent credit back in, the math reveals a completely different story. That is the real value you are receiving, 14.6 cents per share in total economic benefit. This transforms the headline 4.1% yield into a much more powerful grossed-up yield of approximately 5.8%. That is the powerful, but often overlooked, secret of Australian franking credits. Don't think of Telstra as just a phone company anymore. They've moved past the old T25 plan and are now executing Connected Future 30. They are currently a major infrastructure play. Their Infraco and Amplitel divisions own the physical pipes and towers of Australia. In a world obsessed with AI and data, these assets are becoming more valuable every day. Speaking of AI, Telstra's new joint venture with Accenture is already using AI to resolve 3 times more customer queries, drastically lowering their operating costs. No investment is perfect. The risk here is debt. While their net debt is stable, building 5G networks is expensive, and interest rates in 2026 remain a challenge. Also, their enterprise segment, serving big businesses, is growing slower than the mobile side. Remember, this is general information only. I am not a financial advisor, so please do your own research before investing. Thanks for watching.